Great day, great day, great day. Thank you for joining the Cookie Jar FX with your host, Eric Foreman. I appreciate you guys taking the time out for the first video that we have. I think this is major. This is going to be critical for the success of what we're trying to do here. And if you don't know, the idea of the page, the idea of the blog, the idea of just the company and the concept is to show potential traders or people that's in the market how to get involved into something that can, I guess, somewhat duplicate and replicate and create a stream of income that goes beyond the idea of a 9 to 5, but also provide tools and resources and understanding and education, and just some feedback and a dialogue on a world that, for me growing up, wasn't highly exposed. So I think the idea of getting involved into something where it doesn't require a lot of capital, as I'm going to show over the course of this journey, and where you can potentially take it, doing the right things, applying the right disciplines, creating the right psychology behind your effort, and really pushing forward as a community. So this is my journey of trading from $1,000 to $1 million, and showing the world and showing everyone that it is possible. Beginning what we call Brownie Bites. The Brownie Bites is a weekly analysis to kind of showcase what I'm looking at for the week. Different currency pairs, primarily in the forex market. Equities I don't get into. Been there, done that. But I just like the challenge of the foreign currencies. Anyhow, so the Brownie Bites is to give you that perspective, a weekly analysis as to what I'm looking at for this coming week, certain currency pairs that's catching my eye, and that I will be paying attention to every day throughout the week, until we get that closing bell on Friday. Uh, you can choose how you want to prospectively look at it yourself. You can ask questions, and be open to the idea of, yeah, just seeing what I'm seeing, learning what I'm learning, developing what I'm developing, and creating your own insight to the markets. Uh, Other thing about me is that I've been in the industry for a little bit over 9 years at this point. Trading, I'd originally started trading equities in the stock market. Had created investment club called Invest Me, with four of my other friends, two other interns, and we started and launched a company with $30,000 capital that we raised personally, and yeah, just went to work. The challenge is that, as ready as I was in that preparation, there was no real, I guess, understanding of the technical efforts, right? And because I found that to be the biggest challenge, I took the effort to move forward on utilizing and educating myself. Went through a proprietary trading firm, graduated the program, got hired with the firm, decided to leave and go independent. A few years after going independent, had started a different investment club with a large volume of people, called the Barcode Group, and that ended up not going too well. Ended up failing uh, beyond my own control, and then kind of built out from there. And then I've been just kind of beating at it independently since. Some great success, obviously some great failures, as necessary in the markets is paying a price for your education. Um, yeah, and just some great new insights, I think, at this point. So it's really about sharing those insights with you guys, and really building on that. As I said, the dialogue and perspective. So the way the Brownie Bites is gonna go, as I said, we'll do a weekly analysis. I have a number of different picks for this week that I'll share with you guys. But what I will share first is, what do I look for in regards to trading, right? Um, like when it comes to my trading plan. So what I call my playbook. So it's looking at my own rules. I look at this every single day. I will be looking at this every single day. You can take it for your own viewpoint. I'll share it as well on my blog, so that you can look at it as well. So the first thing is the trade management rules. These are rules that is going to help guide and keep me in place to do what I have to do and stay on track to get into that $1 million target, right? So the sequence of targets is to go from 1,000 to a $10,000 balance, go from a $10,000 balance to a $50,000 balance, go from a $50,000 balance to a hundred to a quarter million to a million. So we should be able to reach that. So no trades that exceed 10% of total equity in account, right? Which means that if I have $1,000 in my account, my position sizes shouldn't reach more than 0.10. Obviously, if I'm adding positions as a pro professional trader should, you can build on that. And the only time I'm going to grant myself the opportunity to go further out beyond the 0.10 or 10% of my equities is if it's a cookie monster trade. What I consider a cookie monster trade is too many factors line up in favor and I'm going all in. So I definitely will be going about that. For every $1,000 increase I build out in equity, I will double my position size pretty much, or add a 0.10, right? So in Forex, we do 0.10 or 10 cent standard lots. That's very incremental. But every $1,000 increase, I'm going to increase that amount by 0.10. So even if I have 1,500 in my account, I'm still only trading 0.10. I'm not trading 0.15. Next, risk to reward, 1 to 3. So, or really 3 to 1. So I'll make that adjustment and edit. So risk to reward is, or reward to risk, however you want to say it, means that if I'm risking 20 pips on a move, I need to be receiving at least 3 times that amount in potential profit. So if I'm going to potentially lose 20 pips, I need to be gaining 60 pips on this trade at bare minimum. Or if I'm losing or potentially going to lose 50 pips, I need to be potentially gaining 150 pips. So you always want to play with that risk to reward, because it also determines if this trade is even worth it. If the trade isn't worth it, you shouldn't be wasting your time. So that's number one. A stop loss and take profit must always be placed upon entering the trade, right? So obviously you shouldn't be getting into a trade if you don't even have an idea of where your take profit target is going to be. And you definitely shouldn't be actively allowing a trade to move forward without having your security line in place. That's like the U.S. governor or the White House, for example. The White House just being open to the public, but there's no security officers there, there's no secret agents there, nothing to protect the president. So your stop loss is there to protect your dollars from taking an immense amount of heat and hurt and damage to your account. So it protects your capital. And the most important thing in this game is the preservation of your capital. So always make sure your stop loss is in place. Make sure you know where to put your stop loss, as well as the take profit, where to take that take profit, and make sure it lines up with your risk to reward. Adjusting the stop loss from original entry, right? So my goal is to, obviously, if I'm in a move, I have a 100 pip take profit target. Pretty much by the time I reach 70 pips in profit, I need to adjust my stop loss to that 70 pip location. So it'll be lined up there, and anything above that, it'll hit my take profit. But if it retracts or retraces back and stops me out, it's stopping me out at 70% profit, which means I won't lose any more than 70% of my capital, which is great, because you want to make sure you're winning the majority of the time and not losing. So the 70% I think is a good build out for me to consistently stay on top, right? So Every trade before and after is to be logged and handwritten into a trade journal covering the following. So obviously the trade journal I personally created based off of just ideas and components that I think are important when I get into a trade. Obviously the date, the currency pair I'm actually getting into, the entry price I got into at, my stop loss mark. So obviously when I enter a trade, my stop loss needs to be placed. The take profit mark. So where am I looking to take this ride at? Like how far down, how far up, how many pips? Is it a weekly, daily, 4 hour, whatever? My position size. So as I mentioned, if I have $1,000 in my account, I put a 0.10. That should be listed right here, 0.10 position size. Potential pip gain. So okay, like if my take profit showcases that price is at 1.200 whatever, what is that potential pip gain? So when I use my crosshair and measure it out, it's gonna tell me, oh, this is a potential gain of 100 pips or whatever the amount is. And then obviously the 70% would be, okay, this would be my marker, and I got highlight that with a horizontal line. Like this is gonna be my 70% like marker to adjust my stop loss. A reason for entry, right? So every move that I get into, there has to be a reason why I got into it. So I had to do some type of analysis behind it. There's not no just jumping the gun, getting in with no real perspective as and reason as to why I did it. I'm not jumping into any trades blindly. I may be able to do my analysis quicker than most people because of my years of experience. So I'm not staring at the charts for 20 minutes trying to figure out what's happening. I can literally assess a trade in less than 1 minute and decide whether or not it's for me. But that's because I have a certain trading style and trading plan that I know is my thing. So there's a reason why I got into the trade. I need to detail that reason, detail that analysis, and then kind of move on to the reason for the exit. So the exit part I'm not going to fill out until the trade is done, right? So maybe the trade ended because I got stopped out. Or maybe it hit my take profit and that was the reason why I exited. Or maybe the trade started to shake a little bit or whatever the case is and it took me out. Or I just saw something a little fishy or whatever the case is. But I'm not going to just immediately close a trade unless something real instrumental happened or I made a mistake or an error in judgment and I need to just get out the move. That would really be the only reason. But outside of those rare occurrences, my markers would usually set the reasons for my exits. I'm not going to blindly just jump out of a trade because I feel like it don't look right anymore. So this would be my trade journal that I'll follow and be submitting my entries to make sure I'm staying on path towards our targets. Playbook strategies, right? So these are the moves that I would specifically be taking to adhere to the success of my trading journey, right? These are the only moves I really should be looking at. There's other moves that are in the toolbox that I have, obviously, from my training, from my years of personal experience, so on and so forth. But these are the main priority, like trading strategies that I use that works best for me, that I've seen an immense amount of success, that I can spot on a whim and be able to just execute with ease. So the main ones are the Cookie Monster trades. These are the trades that I'm looking at that grants at least a 90% success. And obviously no trade, no move, nothing is guaranteed. So there's not 100% success rate. But they have the highest likelihood of going in the direction. I've seen them, I've traded them hundreds of times and they work. So it may not always work out perfectly, but for the majority, it does work. So the first is a bottoming or topping tail bouncing off of a major resistance or support level on a weekly or daily, extended from the 8 to 20 moving averages, causing an open gap potential for a cone trade. The cone trade is something that I've learned from the firm that I had got traded with, iFund Traders. And it was one of the key components that kind of built my interest uh, on strategies. And it was like, dang, like if I see this move break and pierce above the 8, and I'll share one of these in the next video, uh, like through an actual chart analysis. But I'm like, dang, when it broke through the 8, it always goes to the 20. It usually always goes to the 20. There's times where it breaks and falls back down, whatever the case is. But for the most part, it usually works. So that's always been my go-to trade. If I ever spot cone trades, I'm taking it, I'm snipering it, and I'm shooting at it. Uh, so that's number one. Number two, the market open gap. So these are like Sunday. Today's Sunday. The market will open later this evening at 5. But sometimes when the market opens, it gaps. Like maybe there was a big event that happened over the weekend and something went down, the market gapped 200 pips or something. And because the market doesn't work like that, price has to correct itself. So that gap has to be filled. When that gap is filled, it gives traders an opportunity to be able to retract price back into that area or to into that spacious area and snatch up pips. So that's one of my most favorite trades. Does it always work out? No. But the majority of the time it does, because gaps need to be filled for a price correction. So that's one of my big Cookie Monster trades. The maxed out 10 bar run with extension. You'll see one of these when I go into my next video, but the maxed out 10 bar run with extension is critical. It has to be extended from the 8 and the 20. And you'll see the spatial gap. And one of the things that I've learned, and I teach a lot of my students that I've had, is the moving averages works as a rubber band. So when you pull and stretch a rubber band, it extends, but then when you let go of the rubber band, it goes back to its original form. So the MAs work in the same ideology. Like it can stretch but so far from each other, and then it has to come back to its original form, or it has to reconnect with each other. So when you talk about a 10 bar move up, that's consistently in the same direction, or move down. So we get 10, 11, 12 green bars to the upside in sequence. A correction has to happen, especially if it's like an extended move and it's shot up or whatever. So that correction happens, we'll get a red signal, and then more than likely the move is going to reverse for a little bit. And that's when I can pull out my Fibonacci retracements and all types of stuff, start measuring out for support levels, for potential targets. Like I'm doing all of it. But it's a huge success rate for me with that type of setup. And it happens more often than not. But the higher the time frame, the better the opportunity. Number 4, a strong rejection of a flat or curved 200 MA on a 4-hour daily time frame, right? So obviously, if I have a 50, a 200, I have all my MAs on my chart. But the 200, I consider it the mother of them all. The most respected moving average on the chart. So if the candlesticks come in contact with it, you best believe something is going to happen. So the candlestick can break above the 200 or below the 200 and then go back in the opposite direction. Anything can happen. But any move that starts objectively approaching the 200, it's time to pay attention. It's time to really microscopic into the move and really see what's gonna be happening. So a flat 200 is great because more than likely I'm going to see a rejection off of that. If it's curved, let's just say downward, it's going to be a rejection off of that. If it's curved upward, there's going to be a bounce after that. So the candlestick, depending on the direction, whether it's below the 200 or above the 200, you can kind of decipher what direction it may go into. But for me, that's how I play that. The bear 180, bull 180. This is going to be a little bit more difficult to explain, being that I'm not looking at a chart right now to express it. But the bear 180, the bull 180 are what some traders call railroad tracks sometimes. But if we're going to the upside, and I see, let's say I'm going to the upside, I got green bars, and I get a big green bar. It's usually considered an exhaustion bar. And then I get a red bar of the same size of that green bar. So I got a huge green bar that's an exhaustion bar, and then I have a huge red bar that's now an igniting bar, and it's igniting the move into the opposite direction. So obviously, the red bar signifies that the move is going to start going downward. Those type of moves I love, especially if I get a little pullback into the red bar, giving more opportunity for a sell. And then the opposite for the inverted would be the same. So if the move goes down and we get a huge green bar, then it signifies that the move will start going up. But the bars have to be of significant size and of equal similarity parallel to each other. That qualifies it to be a bear 180 or a bull 180. So now just some regular trades: top and tail, bottom and tail, rejecting or bouncing off a major resistance or support level, and the RSI lines connect to either 70 for resistance or the 30 for support, right? So if I'm looking at a move, and you'll see it in my next video, but if I'm looking at a move and I'm seeing a potential rejection to the upside on a certain pair, but I'm also seeing on the RSI level that it's at the 70, then it's giving me more of an idea that there's probably a possibility that we're going to start coming down. So I'm going to be looking to build out some shorts. If I even see a candlestick approaching the resistance line, a lot of traders would be stupid enough to, hey, like, I'm going to snatch up those little 40, 50, 60 pips going to the upside, but you don't know if it's going to directly hit it. It might come up short. So it's not worth trading something if it's going to be coming up against a resistance or coming down to a support level. Just let it do its thing. And if it hits it, it hits it. If it don't, it don't. So for me personally, I always like to focus if it actually hit that level or if it didn't. If it didn't, I'm not interested. If it actually hit that level, then I'm all ears. If it broke the level and then retraced back, then I'm all in too. So that's another one of the regular trades that I'll trade. And it doesn't have as much success as my Cookie Monster trades or my Cookie Monster picks, but it's still successful activity. Another one would be a bounce or rejection off of a flat or curve 50. So we know the 200 is the mother, right? So that's why that's the reason why it's in the top pick. But the 50 is also an important moving average too, and you're gonna respect it. So if I see a flat or curve 50 and the candlesticks is about to come up on the approach, I'm paying attention because we're gonna see some type of activity there, and I don't want to miss out on an opportunity. So I'm gonna be focusing in a little bit more in that area and see what's happening. I'm paying attention to the location of the 50 MA and the design of it. Is it flat, curved, downward, upward? And then I'll make a decision from there. The double scoop. So this ties in with our cone trade from number one, but this means that it broke through the 20 moving average and now pushing towards the 50 moving average. And that's usually the best trades too. So if we obviously get that break through the 8 and then we working towards the 20, that's a regular cone trade. Now, if the 50 is behind the 20, then we break then we break that 20 MA and now we're working towards that 50. Oh man, give me a double scoop on that. Cherry on top, please. Cause I'm just looking to eat good on that. Like I'm eating all of that. Cause if it has that much strength, that means the move is strong and solid, and I want all in. So that's a good trade. Just some basic quotes just for me to read every day as I read through my trading playbook every single day. Trading is an exercise in getting better every day. You have to be willing to put in the work every single day. I remember one of my good friends talking about, Eric, like the reason why you have your success and then also have your failures in there is because like you just take these breaks whenever you want to take these breaks, and that's I had to kind of take his word on that and honor that. Like I'll do well and then I'll take a break. I'll withdraw my funds. I'll do whatever I want to do, and then I'll get back into the market. Or like years ago, one of my most favorite brokers, Forex Broker Inc., they had closed down. I had no other trading home to go to. I felt homeless, literally. So because of that, I ended up just taking a break. And then I was moving. I just got married, so on and so forth. So there was a lot going on in my life. So I was like, trading's just not the time. But I think that's also a flexibility that you get with trading. But the challenge is that this freedom is very different from like a 9 to 5. And it kind of goes into another quote here. First comes the professional trader. Only then can a trader become a consistently profitable trader. Like you have to take this serious. And the times that I have taken it serious, like, look, this is a part of my job. This is a part of my work. This is a part of my life now, where it's an important emphasis to ensure my success. And when it's looked at like that, you just move about it very differently. This is not a 9 to 5. You're not clocking in. Nobody's on top of you. Nobody's checking in on you. There's a freedom and flexibility that traders adapt to, thinking that, oh, like I can try to trade on the go. I can get into whatever I want to get into on the go. Like I don't really gotta analyze that deep. Like, no, there's a commitment to it. So it's an exercise you have to be willing to put in every day. And I plan on exercising every single day to, I guess, work and build the trading muscle that I need, and the strength that I need to get this account from $1,000 to $1,000,000. Do not trade setups that are not worth your intellectual, emotional, and financial capital. So obviously, I'm not trading into no bullshit. So if it's not a part of any of these trading strategies here, or at least one of my back pocket trades that I'm including into one of these strategies, I'm not wasting my time. Point blank, period. And as a viewer and as a subscriber and as a supporter, if you see it, call the brother out. Like, yo, like I saw your analysis that you did for Brownie Bite Sundays, and I don't know, your analysis seemed like it went against your trading plan, or one of your trading strategies. Why did you do this? Because there's probably a reason why I did it. But more than likely, I will also explain it in my video. But yeah, like if it's not a part of my strategies, I shouldn't be trading it because it's not worth my intellect. Because obviously, I'm putting in all this mental work behind what I'm doing, and I want to make sure that I'm not stressing my psychology behind it. It's not worth the emotional toll either. Just taking on losses, like that starts beating on you. And it's not worth the financial. I'm not trying to give all my money away to the markets. No, thank you. I have a reason why I'm doing this. I have a reason why I'm building this account. So let's build it correct. The emotions that come from first in fear of missing out, FOMO, are often associated with an unmet developmental need of validation that can overwhelm one's intellect. And the reason why I put this is because for me, it was an important part that I'm not trading to be validated by nobody. I'm not trading to impress anybody. I'm not trading to try to gain this big reward to provide as a entertainment and lifestyle, start pulling out Lamborghinis, and I'm not trading for that. I'm literally just sharing my trading journey. That's all I'm doing. I want to share it, expose it, really showcase that, look, I got a wild upbringing, but I want to show to myself and prove to myself that it's possible. And I want to share that with the world, like, look, this is possible. And with certain tools and certain disciplines, you can get there. So that's what it's about for me. Is like, look, I've been doing this for a while, and one of the things somebody has said to me is like, what good is any information or skills that you have if you're not willing to share it with the world? So this is me just sharing it with the world. So it's not about validation for me. It's really now about, look, I got some skills, I got a craft, I got some insight, I have some experience, and this is an idea that I've had for years, as a book, as a lifestyle, as a YouTube channel. Like, I just want to do something, and it just made sense now. So that's another important part. And I'll go to this last one. You have to be ready to be successful before you are successful. So obviously, the playbook builds on me being successful. Having my trading journal builds on me being successful. Doing my analysis every day, every evening, every week, um, builds on my success. All these different components help build out the successful trader. So there's no better preparation. Like, LeBron James ain't going into no game if he ain't practiced or if he ain't hit the weights. He hasn't sat with his personal trainer. He hasn't reviewed tape. He hasn't sat with the coach. He hasn't met with his other players and teammates. He hasn't looked at the challenging opponent team and studied what players and what good do they have. So there's some success that builds on other success. Like, you have to be successful at the preparation. You have to perfectly practice before getting into the game. So I think for me, it's just about perfecting that little success. Like, look, I put my trading journal in. That's a little success. I'm putting in the work. That success is going to lead me to being more successful into my move. Look, every morning, every day, every evening, I read my playbook. I got it mastered. I study it to make sure that mentally and emotionally, that success in my head is being built up for it to transition and translate directly into my trading activity. So you have to be ready to be successful before you are successful. Um, so that's it on this video. I appreciate it. Let's really get into some analysis, and let's get into the work. I'm ready to get to this business. Subscribe, hit that like button, share, follow, and really be out there. If you're looking for me on Twitter, the name is Jar underscore FX, or just type in Cookie Jar FX. I'm on there. I'll start posting a bit more. If you're looking for a website link for the blog, it's www.cookiejarfx.com. Find us on Instagram, Cookie Jar FX as well. I haven't started posting on there yet, but I will. But most importantly, subscribe to this channel. Hit the like button, show some love, send a comment, share it with a friend in need. Yeah, and just be like, look, this guy, he talking about flipping $1,000 to $1,000,000. I ain't never heard nothing like that. He sound like some commercial ad or some get rich quick scheme. This ain't no get rich quick. I can promise you. I'm not saying this is gonna happen in the next 30 days. I'm not even giving a timeline on it. What I am doing is just sharing the journey. Similar to how you would see a high school star player turn pro, is really me just showcasing my athleticism in the markets and showing you how to really build your account or build my account into a professional level, without getting any extra funding from proprietary trading firms or anything. But also sharing my losses, my mistakes, my errors, my bad trades, my losing days, my losing months, my losing weeks, whatever, and really being reflective of what's real, and being very transparent. So I'll share my account, balances. You'll see all of that. Like, it's gonna be real. Like, as I say from the hood, just always keep it 100. That's all I'm saying. So, yeah. So that's that. Appreciate the support. Appreciate the love, and definitely looking forward to the next video where we'll get into some technical charts and what I'm looking at going into this week. Thank you. Subscribe, like, and I'll catch you on the next one. Happy trading.